Welcome to Wealth Matters Podcast. I have with me Ressa. Uh, Chris is focused on retail world, and with his dedication to solving real estate needs for entrepreneurs, coupled with his ability to thrive under immense pressure, Chris hasn't let the pressures of the world affect who has set out to be. No wonder he has been recognized by the chain store Age for his achievements and made it to their 10 under 40, the Dazzling Dozen. I don't know, Chris, if I can do justice to your bio, so feel free to add.
That was perfect. You're good.
So, Chris, welcome.
Thank you. Well, I'm happy to be here.
Yeah. Tell us something interesting about yourself, something funny, something which we wouldn't think of.
I'm a fantasy football nerd. I love
Oh,
fantasy
really?
football.
Okay. How's it going now, though? Right?
I don't know. We'll see what happens.
Right. So, give me an idea. Why did you choose to be in real estate?
I grew up pretty blue collar. I went to college on a wrestling scholarship. Otherwise, I wouldn't be able to afford to go.
Wrestling. Okay.
Yes, I
So
went to Rutgers.
that's actually interesting than fantasy football.
Yes, I am. I went to Rutgers University, and
Okay.
I wanted a job in quote unquote corporate America. I didn't know what. So I was looking at jobs on Wall Street. I was looking in, different types of corporate business. And there was a recruiter on campus for the Sherwin-Williams company, the paint stores company. And they were looking for a corporate real estate professional and someone who went out to find new stores, district offices, industrial warehouses, and they would go and you were solving all the real estate needs for this Fortune 500 company. It sounded really interesting. And so I moved to the Philadelphia area and worked out of their Malvern office. And I got lucky. My first job, I fell in love with commercial real estate. At the end of the day at Sherwin-Williams, unbelievable company. That's a paint company though.
Yes.
I then realized I wanted my focus to be real estate, and I ended up going and working for a company in New York called Ashkenazi Acquisitions, which is a company that owns and operates retail real estate across the country. And that led me to DLC, and that's where I've been since. So I got into commercial real estate by chance and just ended up falling in love with it. So at least in my world, that's how I landed in retail. I'm glad I stayed in retail. I had the good fortune to see different types of real estate as a user at Sherwin-Williams of the real estate, not the investor, but the user, and how they evaluate real estate needs, both from the retail perspective, the office perspective, the industrial perspective. And I realized I loved real estate, but wanted to get on the landlord and or developer side. And that's what I did.
That's awesome. So what was your very first deal? Like first acquisition or very first real estate transaction?
My first real estate transaction was in Matamoros, Pennsylvania. There was a strip center, and I put a Sherwin-Williams in that shopping center.
Awesome. And what was the first deal for yourself?
So when I went to Ashkenazi Acquisitions, I was always working for a different company. Even at DLC, I'm a partner in DLC, and we invest together. But I would say for me personally, with no partners, no anybody, was a duplex in Phillipsburg, New Jersey that I rent out and I still own today.
Oh, wow. Nice. So you do have some residential properties as well. So why did you, now that I understood that, of course, you learned about commercial real estate from Sherwin-Williams, but why did you pick up retail like strip malls and shopping centers, or why did you continue to be in that area?
So when I was at Sherwin-Williams, I was looking at, I was involved in retail, I was involved in office. They had, industrial, and retail to me was much more complicated. it is not, it is much more than a pro forma. Like right, you're talking about, the real estate has to work based on the revenue of the tenants there. And so you
Right.
have to really understand how co-tenancy works, and does, when this user goes next to this user, do their sales go up? When, why is this corner better than the corner across the street versus like, I need an office, whether it's on this corner or that corner, probably doesn't make a lot of difference in suburban
Right.
America. Right. And so the complexities and the strategy and the different ways to create value were so much more intriguing to me.
Got it. So like anchor tenant as well, right? You have to look for an
Yeah.
anchor tenant. Okay. So what are the going cap rates in retail space, especially where you are investing right now?
So what I would say about retail is one of the more interesting things, and if you thought about it, right, and most people don't, is there are so many different product types in retail.
Okay.
And if you look at the public REITs, you can see this. There are a myriad of different public REITs in retail. There's so many because every product type is different, right? So you have enclosed malls, right? And think of
Yes.
any retailers in an enclosed mall, whether that's Macy's
Yep.
or Victoria's Secret or Bath and Body Works. But if you think about them, you don't really see them in your neighborhood grocery anchored center, right?
Right.
You don't, right? And that's a different product type.
Yeah,
So you
that's
have
a
the
whole
grocery anchored
different.
center,
Yep.
which is a different product type than the true triple net lease freestanding building, which is a different product type than an outlet center, which is a different product type than a power center being like a Walmart, TJ Maxx, Bed
I
Bath and
see.
Beyond, Dick's
Okay.
Sporting Goods. They're all the same industry, but very different businesses and
Right.
how to operate those properties. And so when you think about cap rates, they all trade differently. One of
Right.
the biggest things that, there's a couple of things that determine cap rates, right? You have the creditworthiness of the tenants.
Right. Yes.
You have the unit economics, meaning how well do those tenants do in that center. That
Hmm.
plays right. So when you're buying retail real estate, you have to understand sales, right? I have, I know what the average sales are of a Starbucks, of a TJ Maxx, right? And so even though they have a 10-year lease and you have the corporate entity, you want to know the unit economics. How well does that location do, and how is it done over time? You need to know, so you have the creditworthiness, you have unit economics. You need to understand, just the location itself. How good is that location? And so there's all these things that go into cap rate. So, and the market itself, right? So
Right.
I would tell you that cap rates are all over the board in retail.
Okay.
All over the board.
So it's not like multifamily or mobile home park that you exactly know. You even, yeah, as soon as you look at the sub-market or the metro, you exactly know. Okay, Dallas, it's 4 to 5, right? If it's
You got
California,
it.
3 to 4. But
It's
okay,
not that. You could have
yeah.
two grocery anchor centers across the street in the same market trade at very different cap rates.
Okay. And also there are other variables like triple net lease or double net, right? So
You got it.
yeah, okay, interesting. So
That's what makes it fun, though. I like that it's not
Yes.
cookie cutter.
Yeah,
right?
yeah, that's good. It's not boring.
Well, I also think that's where the more information you gather and more data you gather, and the more the more you could take advantage, and the more fragmented the market is, the more opportunities there are.
Right.
The more programmatic and cookie cutter the market is, it's much harder to find, that value creation piece.
I see. So, how do you evaluate a deal, right? So let's say a deal comes across your desk. I'm pretty sure you have an entire team who is evaluating. But
Yeah.
what do you look for in a deal?
So do you want me to get specifically like to our business strategy, or do you want me to just like generally evaluating real estate deals?
Yeah, let's talk about generally, and then I may have a question and we can dig deep.
So I think generally evaluating, and I'll look at retail real estate deals. I mean, The first thing, we always start wide and work our way down, right?
Okay.
So we're first evaluating, like I think everyone in commercial real estate is evaluating the market, right? And we're looking at job growth. What are the employment drivers? We're looking at population growth. We're looking at housing growth. We're looking at all the typical things that anyone looks at from a market perspective. Are there universities, where healthcare systems, all those types of things, roadways, geographic barriers, all those typical things, right? Is, what is the right side of the river to be on, those type of things. We're looking at all the geographic and all the market things that most people look at. And then what I would say on the evaluation of the deal, I think we're looking at, it's more than just the pro forma. And I think, that's one of the biggest keys is if it's just the numbers and there's not more to it, I'm concerned. There has to be the intangibles and the opportunities outside of the numbers. Otherwise, I'm less excited. So, those intangibles, have to be able to, and those intangibles lead to you have your base case and then your upside case. And if the intangibles are there for your upside, right, have information, right, whatever that is, that in what the market doesn't, that in 3 years, Amazon's going to build a distribution facility and there's going to be 2,000 more jobs.
Right.
That's an intangible, right? That you've got wind and you can use that fragmentation to, leverage the market. If you're just looking at deals and looking at the pro formas, then I think it's challenging to do that because that's what everybody's doing. It's a very competitive marketplace.
Exactly.
Right. And so, but I would go back to what we were talking about before. We're looking at, as it relates to retail, we're looking at in the market, are there tenants who are missing? Right. So are there uses or are missing? We'll take a gap analysis, which looks at the retail spend in that trade area, and then look at, okay, is there a gap? Is there more demand for certain retail items than is actually being offered in this market? So is there demand? We'll look at from the property level, just who we have software systems, and we'll run a void analysis to know that these national retailers are missing from the market. These local types of uses, there's demand for them in the market. We will then look at the lease terms of the leases, right? How stable and durable are the cash flows, right? So we're running risk, right? We have our watch list of tenants of who we think is right. We know from what's going on, watch list of tenants of who might file soon for bankruptcy, who might not, who's poised for growth, who's owned by private equity, which is, could be a challenge, who's public, who's private. And so we're going to look at the durability of that cash flow and use our own model to evaluate that durability of the cash flow stream. We're going to look at the vacancy because the vacancy is all upside. In our model, we don't pay for vacancy. So we are, right? So that's we want some meat on the bone to leverage the platform to drive vacancy. We're going to look at, are there other future development opportunities? That's a big piece for us when we're evaluating a deal. Are we able to develop a pad for Starbucks or McDonald's in the front of the center? Are there restrictions? What are the zoning requirements? All those type of things. These are the types of things we're looking at. This is not, I didn't have my, we have our due diligence checklist. I don't have my due diligence checklist in front of me, but these are the types of things we're looking at.
No, this is awesome. So do you go through certain softwares or tools to evaluate this? Of course, I'm pretty sure you have your own platform, but like publicly available, like CoStar, etc.
So yeah, what I would say is I think one relationships matter.
Okay. Oh,
So
yes.
nothing more important than, you know, the market knowledge from relationships. So that's the number one tool is and I wouldn't call relationships as a tool, but I would say is like, you need to have relationships in order to make, the anecdotal information is as important as the empirical data. We run our models through Argus. That's what we're running our models through.
Okay.
We use Placer AI, which
Yes.
tracks traffic to properties.
Yep.
Those are probably two of the biggest software tools that we use. We use Credit Intel, which is a software that it's a platform. They actually advertise on our podcast and they monitor the financial health of retailers, but they can also do things like I type in an address and it'll tell me in one button what national retailers are not in the market, which national retailers have announced to the street that, you know, they haven't opened to buy in these markets and things like that.
I see. No, that's great. Hey, so what are some of the gotchas to keep in mind while underwriting retail space, right? And of course, it would depend on, type of asset as well in retail. But what are some of the gotchas for someone who is starting? Or let's say I'm planning to acquire a strip mall. What should I look at? Why?
Yeah, it's a
Underwriting.
great question. Here's one gotcha. I'll give you one that I constantly teach our team. Who the signatory on the lease is.
Oh, okay.
So, right. So you're buying a income stream and you're basing a cap rate based on the durability of that income stream.
Right.
And therefore you better understand where that income's coming from. And a lot of times, right, if you think of, multinational corporations, right, in general, when I sign a lease with Starbucks or Walmart or TJ Maxx, you get the entire company signs the lease. You sign a lease with Google or Facebook, you should have Google on the Alphabet on the lease, hopefully, or at least Alphabet as a guarantor, hopefully.
Yes.
But if they have it in some separate LLC and you don't have a guarantee, well, then you really don't have Walmart or Dollar Tree. You've got the name on the front of the building.
I see.
But if they don't pay you rent and you go to court to sue, there's nothing there. So I think understanding the entity, and you see this in a lot, I think, in my world with franchise-driven businesses.
I was going to mention that franchises
right?
is where
Because
you will see this.
You see this a lot because some investors may think that you have the corporate entity on the lease where you just have the franchisee. The franchisor is not guaranteeing the lease. And so, you might have a guy who only has 3 locations where you thought you had the 20,000 that Dunkin' Donuts has.
Makes sense. No, that's a great tip. So can you talk about your best deal at DLC so far?
Best. I mean, we've had a lot of successes. I think that, the one I'm most proud of recently is, in Vernon, Connecticut, we had a property that was upside down with its mortgage.
Okay.
And the loan was coming due. And it was upside down and the property was 90% leased. So typically if the property is upside down and you have vacancy, you can solve it through leasing.
Right.
There's no income to add unless you do something major. So we had a bunch of things working on. We had one, we were working with the lender to try to buy the mortgage out.
Okay.
We at a discount, and then we were working to restructure our own internal capital stack to bring in a partner. And then we had a ticking time bomb, which we had an anchor tenant and the lending world knew that didn't want to be there. And while they were creditworthy and were going to pay the rent for the balance of their 7-year lease term, we were challenged by the fact that everyone knew at that point they would go. and they might go dark and pay the rent during that time period, which could impact the balance of the tenancy in the center.
Right.
And so what we ended up doing was we were able to work a termination with that tenant simultaneously while signing a lease with the new anchor ShopRite and HomeSense, who is a TJX concept, which owns TJ Maxx, Home Goods, Marshalls. Okay. And so all these things came together at once, which was buying out our existing lender, bringing in a new partner, signing a termination agreement with a anchor grocer, bringing in 2 new anchor tenants all at one time.
Nice.
So really, really hard to accomplish. And that was the beginning of last year. And now we're in a much better leveraged position. We have the right capital stack and we have a great tenancy. And we actually just finished our construction this year in bringing in ShopRite and HomeSense. Actually, ShopRite opened, which is the grocer out here, right before the pandemic. So when they opened, they actually had, much higher sales than they had originally forecasted because of the panic buying in the beginning. So they were off to a good start.
And actually, most of the grocers, they are doing good for even after the panic, because everyone is still trying to hoard, right?
Yeah.
No, that's great. What was your worst deal, if there was any?
Of course, everyone's got bad deals.
Yeah, you got to. That's the education, right?
You have to have bad deals. The worst deal, I would say that we owned a mall in Ohio, and there's a lesson here, and we were not an enclosed mall buyer. Enclosed mall business and the open air, call it strip center business, are same industry because it's like retail, but totally different business.
Totally different. They are dying. Malls are dying.
And so we were buying when malls were doing this, when malls were doing well. And this mall was challenged before the challenges of malls had happened. And we were seduced by the price. The seller kept lowering the price and lowering the price to a point where on paper, it just seemed like you couldn't lose. And it was a mall in Steubenville, Ohio, and we could not bring it. The market forces just would not let our, platform, leverage the platform to, enhance that property. And so that was a lesson on probably, at the end of the day, don't be seduced by the price.
I see. That's a great point. So let's take a quick break, and after the break, we'll continue with the fire round. Welcome back to Wealth Matters Podcast. I'm chatting with Ressa, who is also the host of Retail Retold podcast, which I forgot to mention. So I highly recommend anyone interested in learning more about retail, definitely listen to his podcast. So Chris, after the break, usually I go through the same set of questions with the guest. It's called Fire Round. Are you ready?
I'm ready.
Okay, let's go. And I think this is also one of the questions I really want to know about retail. Would you be changing any business or investment strategy after coronavirus?
So on, business strategy, I think one of the things that we are looking at is more M&A deals versus just one-off properties.
Okay.
There might be a dislocation there more than there is at an asset level. So that's one from that perspective. Because right now, even regardless of what has happened, and I think this is the case in everything, in every asset class, there's still I think we're going to look at the end of the year and look at the transactions in every asset class, not just in real estate, in everything between April and call it September is going to be one of the lowest transaction volumes that we have, right? And I think that one of the big reasons is because if you're a buyer of any asset in any industry, whether you're in the airplane industry, you're in the real estate industry, you're in the tech business, you're looking for COVID pricing.
Yes, of course.
And sellers, in general know that and not necessarily prepared to give it at COVID pricing unless they are forced to sell for some other circumstance. And
Right.
so I think that's creating low transaction volume in the world in all assets. And so you have that. And I think that when, so on an asset level, I think for real estate, it's still, there's this bid ask issue. And so one of the things that, we're looking at is, it seems that when you roll up to an organizational level, there is a little bit more dislocation.
I see. So, but have you got any impact on your portfolio because of all this? Because I'm pretty sure
Oh, yeah.
retail strip malls, they were shut down
Of
a lot.
course. So, fortunately, there was a new word that, me being in retail, the government's made up, which was essential retail.
Yes.
And so that, I've heard every word in the world: department store, discount department store, value, off price. But this was the first I've heard of this word. And all those other words, my industry created. This was created by the government.
Yeah.
And fortunately, first time, fortunately, we had a lot of essential retailers.
That's true.
And so those tenants typically paid. But rent collections are off for sure. We are at 93% for April. Okay. We're down, we're in the 70s for May and June.
Wow.
And so we're down, but the ones that haven't paid, we're working on cutting deals with those tenants.
Okay.
What I would tell you is, outside of some public national bankruptcies to date, and I think we'll see as PPP money runs out and things happen, we haven't had the fallout of vacancy that headline news is calling for.
Right. Yeah, I'm surprised as well.
I think government has helped in that regard.
Oh, for sure. I was very surprised how quickly they came up with that much money.
Yeah.
How quickly all of them agreed, which is unheard of.
Our biggest changes have not been from investment strategy and business strategy, have been operationally.
Okay.
Right. Our biggest changes have been, right, I have 120 employee company, and we're all working remotely. Yes. We have properties all over the country, and so getting to those assets is challenging.
Yes.
We have we've now, one of the interesting things is in retail, at the end of the day, there are very few companies that can. The myth about retail, here's the myth, and I think this is the punchline. The myth is that it's cheaper to be an online business than it is to be a brick and mortar tenant.
Yes, yeah, that's what I even thought of.
And so that's the myth. It's easy to start up. If Alpesh and Chris decided we wanted to sell t-shirts,
right,
it's cheaper for us to start online. Startup costs are cheaper. But as you scale, it gets vastly more expensive to set up infrastructure and distribution across the country and deliver the product. Typically at a company, they get about 10 million in revenue where they have to get to multiple markets. It gets very cost prohibitive. And it took Amazon, and there's still question today if they actually profit off of the selling of retail goods. It took them 20 years to get to profit. And you look at Wayfair, they lose money every month. There's no doubt consumer behavior has changed, and we're not blind to that. We understand that, and I'm long on retail. But I think there's something at the end of the day when you can only lose money for so long. Eventually, investors and VC firms want to make money, and that's why you saw a lot of digitally native brands starting to open up brick and mortar stores.
Oh yeah.
And so when I bring it back to what has changed, one of the things that happened that started pre-pandemic was this buy online, pick up in store.
Oh yes.
And the about pre-pandemic, about 15% of retail sales were done online. During the pandemic, it was about 30%.
Right.
So what would have took 5 years happened in about
in 3 months.
3 months. But that, I think the key is, I think we're going to find out that the majority of that increase in sales was fulfilled at a store.
Yes.
Whether buy online, pick up in store, because it's just cheaper for 4,000 products to go to one store than it is for 4,000 products to go to 4,000 different households.
Right.
And so in a place where the consumer's craving value, at some point, Amazon spent $4 billion on shipping in Q1. And so I think at the end of the day, at some point, you have to solve what they call the last mile. And I'm hopeful. And you mentioned what has changed. Probably the biggest change operationally has been buy online, pick up in store. And so we've had to set up things at the centers, parking spots where customers can come and
wait in the car. Yeah.
Wait in the car for the product to be delivered.
Right.
And that could be the solve where it's convenient. I want a product right now. I order it on my phone. I drive by the shopping center, I park, and they pick it up. And if I'm the retailer, if I can actually get them to go in the store, which most of them do, they go in the store, the ancillary purchase that's made after
that's the big
very
one.
accretive.
Yep. Yeah, that's a big one. No, thank you.
So buy online, pick up in store is one of the biggest operational changes.
That's awesome. Favorite real estate or finance or any other related book?
I don't have one that's really. I read a ton. I don't have one that's really earth shattering. For me, it's Rich Dad Poor Dad by Robert Kiyosaki.
Yeah, it's like almost more than 50% of my guests, including me. Any tool or website you recommend or you can't live without?
I can't live without. LinkedIn.
Yeah.
LinkedIn. Follow me on LinkedIn. I'm on LinkedIn. Ressa on real estate is my hashtag. I'm on LinkedIn every day. So
awesome. Any advice for beginner investors?
Yes. They're the two, and Robert Kiyosaki talks about this all the time, which I would say the two biggest things to do from an education perspective are network and read. And I think, no one, that's not earth-shattering news. What I would say though now is in a post-COVID world, networking is going to be different. And, I think we need to talk about networking more, because if you can't travel and see someone face-to-face, I think you need to be really skilled in how to network with people. The old school, hey, can I grab 5 minutes of your time for a cup of coffee? That might be gone, and you might have to, how do you get that person to dial into Zoom?
Yes. Oh, that's a great point. How do you give back?
One of the things that helped me more than most in my life has been the sport of wrestling. So I volunteered, structurally volunteered coaching a lot. For a decade, I was a coach. As my career grew, I couldn't formally coach, but I still help out in the wrestling community as often as I possibly can.
Thank you. That's amazing. How can my listeners reach out to you?
So you can follow me on LinkedIn and reach out to me there. Ressa on real estate. It's RESSA. You can, listen to the Retail Retold podcast, which if you're interested in some deal structures, and we talk a lot about development on that show and commercial development, so you can get that, but it's the story of how that store ended up in your neighborhood.
Got it. Awesome. Thank you. I had fun, Chris. Have a great day.
Thank you so much. You too.
Take care.